All right, let's talk about a hidden force in the global economy. I mean, this thing is an engine funding thousands of businesses, from names you know to the startups you're going to hear about tomorrow, and it's all happening almost entirely out of the public eye. So that question right there, it's not a hypothetical, it's real. There is a massive lending ecosystem. We're talking comparable in size to the stock market that's operating completely through private deals. It's called private credit. And, understanding it is absolutely key to understanding how money really moves in today's world. So, what is it exactly? Well, at its core, the idea is pretty simple. Imagine a company needs a loan. But instead of going to a big bank or issuing a public bond that everyone can see, it negotiates directly with a specialized fund. Think of it like the direct-to-consumer version of corporate borrowing. And that word private, that's everything. These deals aren't listed on some public exchange for the world to see. Now, this idea isn't brand new or anything, but its incredible, explosive growth, well, that has a very specific origin story. To really get why private credit is so huge today, we've actually got to rewind the clock to the last major financial shockwave. To see how we got here, all you have to do is follow the money. I mean, back in the 90s, banks were the undisputed kings of business lending, no question. Then, bam, 2008 happens. The financial crisis hits, and a wave of new regulations makes it way harder and more expensive for banks to make certain kinds of loans. So what happened? Their market share, as you can see, just fell off a cliff. And that left this huge vacuum in the market, a vacuum that private credit funds rushed right in to fill. And the result of that massive shift? An industry worth at least, get this, $1.7 trillion. To put that number into perspective, that's roughly the size of the entire U.S. high-yield bond market. So yeah, this isn't some tiny little niche anymore. It's a central pillar of our economy. So, how did it get so big so fast? Well, it turns out private credit offers a really compelling deal for both sides of the transaction. Let's break down what's in it for the companies borrowing the cash and what's in it for the investors lending it out. You can really see why this took off when you look at it from both angles. For the companies doing the borrowing, it's all about speed and flexibility. They get a loan that's custom-tailored for them, and they get it fast, all without broadcasting their business to the entire world. And for investors, it's pretty simple. The chance for higher returns, a way to diversify away from the roller coaster of the public markets, and a built-in defense against rising interest rates with floating rate loans. It's just a really powerful combination. And here's a perfect real-world example of this in action. Park Place Technologies. They needed a massive $2 billion financing package. Instead of going the slow, traditional bank route, they went straight to a private credit provider, Blackstone, and got the whole thing done. Deals just like this one, big and small, are happening every single day. Okay, but here's where the story takes a turn. A rapidly growing trillion-dollar market that's operating in the shadows? You just know that's going to raise some questions. Is this system really a win-win for everybody? Or are there some hidden risks that we really need to be watching out for? First, let's be super clear about the reward part of that risk-reward equation. Investors are flocking to this for a reason. As this chart shows, private credit has consistently delivered stronger returns than other stuff, like high-yield bonds. But as we all know, high returns, they rarely come with high risk. So the big question is, where is that risk hiding? And here it is. This is the catch. See, when one of these loans goes bad, when a company defaults, private lenders get back significantly less of their money. We're talking around 33 cents on the dollar, compared to over 50 cents for traditional bank loans. That difference, that's basically the price you pay for the chance at a higher return. So who's actually taking on all this risk? Well, this is where it kind of gets personal for a lot of us. The single largest group of investors in private credit are pension funds. Yeah, we're talking about the money that manages the retirement savings for millions of people. So you see, this isn't just some abstract market for Wall Street. It's deeply connected to our collective financial future. And these are the exact kinds of concerns that have regulators at places like the Federal Reserve paying very, very close attention. I mean, think about it. These loans can't be sold easily if a crisis hits. The market is funding companies that might be too risky for a regular bank. There's so much dry powder, that's cash waiting to be invested, that lending standards could slip. And all of this is happening in a more opaque, less regulated corner of the financial world. So you've got this explosive growth on one side and these pretty serious emerging risks on the other. Where is this all heading? What does the future of lending even look like? And if you thought 1.7 trillion was a big number,
Some analysts believe the total potential market for private credit could be as large as $40 trillion. The incredible growth we've seen so far, it might just be the opening act.
And this market isn't just sitting still, it's evolving and fast. It's moving up the food chain to fund giant blue chip companies. It's getting super creative, financing everything from airplanes to music royalties. And maybe most importantly, it's starting to break into the mainstream with new products that are opening the door for everyday retail investors to get involved.
Which brings us right to our final, central question. Look, private credit undeniably filled a critical gap in business financing. It created a more diverse and, you could argue, a more efficient system. But as it steps out of the shadows and becomes a true cornerstone of our economy, we have to ask ourselves, has this innovation actually made the financial system stronger and more resilient, or has it simply moved all the risk into a new, darker corner where it's just harder to see and manage? That, right there, is the trillion-dollar question facing us today.